Good morning and welcome, Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and our toll-free number, 800-951-0592, the website at allamericangold.com, and welcome to Friday. And man, what a year it has been. Really, the last couple of years, you just never know. Well, most of us were sleeping last night. Absolute insanity breaks out overseas in the UK, Great Britain. Huge currency situation playing out as we speak right now. The pound sterling at an all-time record low. It's fallen just since the beginning of this morning, over 3%, which is in currency terms is massive. The pound now almost to parity with the dollar, $1.09 to one British pound. And Jason, this is causing chaos everywhere. Wall Street is down over 400 points below 30,000, 29,000 and change. The S&P below 3,700. The NASDAQ below 11,000. But the word of the day in the UK, so just like everybody else, they raised rates this week. Now, their central bank and our central bank are the same. Well, you know, we took all the central banking ideas from the English, so it kind of makes sense. They were only raised 50 basis points. We raised 75. Their vote was split 6-3. The three dissenters, which for those of you that don't know, that's like an incredible amount of dissenters. That's normally it's 0. Every once in a while you have one dissenter. Once in a blue moon, maybe 2. 3 is very, very unusual, and all 3 of them wanted to raise 75 basis points. But here's what happened last night. The British Parliament is capping energy prices. They're going to essentially rack up massive amounts of debt because their people can't afford to pay their power bills. And then on top of it, Jason, they just passed a massive tax cut. Essentially, the British government's going to make inflation worse, while the central bank was trying to rein it in. And these conflicting policies has caused the pound sterling to almost all but collapse here.
Well, I guess that'll help the euro versus the yen. That's what will happen when they spend a whole lot of extra euros, Joe, or pounds or whatever they're going to print to cap energy prices, and that's not good. You know, once you take a free market and cap it, Joe, that's a bad sign.
It never works. You brought up the euro down to 97 cents. The Japanese yen back above 143. Remember, so almost 2 days in a row where we've had these are G7 countries, right? 2 G7 countries in a row this week having currency problems. The Japanese trying to hold that line in the sand on the 145. But here in Britain, you have the government working against the central bank. And I think a lot of people fear as our economy slows down, are we going to end up in that same situation where the government starts spending a lot more money at the same time rates are going up, and it really is counterproductive.
And not to mention, China is just sort of censoring anything looking at their economy, how bad that thing's going. So you can just add that to your – yeah, it's bad.
That's another great one. This is a currency crisis the world has never seen. This is what happens. You know, think about Weimar Republic there in Germany where they were stealing, putting all the cash in the wheelbarrow. Venezuela had the same. They were weighing money. They dumped the cash out and steal the wheelbarrow because the wheelbarrow was worth more than all the cash that was in it. And Jason, now this is global. Right, this is global. The central banks papered it over so many times. Today, Goldman Sachs has given up. They're kind of the last bank to just give up, cut all of their Wall Street estimates by almost 20%, and I don't think that's going to be enough as we're watching this thing kind of disintegrate before our eyes. Because what do? Right? Hey, wait a minute. The citizenry's struggling. They can't pay their bills. And for the last 50 years, all these central banks is like, oh, the second there's a problem, let's throw money at them. Well, that's what the English Parliament did, and it's caused chaos.
So I guess the next step for Europe and England will be to raise the taxes then to pay for it.
Yeah, and that's the thing. England cut the taxes.
Oh boy!
Right? They went the other way. They not only did they give out the money capping the energy prices, then they passed a massive tax reduction, and across the board too. They gave it to everybody. The rich people got it, the middle class got it, the poor people got it. And again, now already the British 10-year note. Yielding just as much now as a U.S. 10-year note, about 3.8%, and people now saying that the Bank of England, in order to offset what the Parliament just did, is going to have to raise a full point at the next meeting.
I guess the wealthy people of England are getting ready to flee. That's what you just said, Joe. Wealthy people in England are now going somewhere else immediately.
Patriot Radio News Hour. I know it's Friday. Crazy things happening. We'll be back after the break. 800-951-0592. Patriot Radio News Hour. Joe and Jason. Goldman Sachs. These are, you know what, it's so funny. When we look at these banks, I'll call it the stock cheerleading guys. This is a big reason why so many people have lost way more money than they should have. You know, Goldman Sachs was telling people at the beginning of the year the S&P is going to be over 5,000. Up until this morning, they were still saying 4,300. Well, they've gotten rid of it, Jason, now saying 3,600 with a caveat. That may be because you know already. Listen, it's so funny. Oh, 36. The S&P's 3690 right now. So obviously, well behind. They did throw out a caveat that it could go as low as 3,150, and I'm just going to say this: that's a pretty significant fall because this is just a prediction for the end of the year, Jason.
So just the end of the year. That's that's significant, Joe. That's very significant, and we've talked about how far will the markets go and what's the timetable, and maybe this is going to be a slow grinding slide because that kind of matches that. I mean, it's not a huge drop. But that's a big drop. So what happens in 2023 would be the next question.
Yeah, and that's the thing. And again, they're still trying to. I guess, and I don't understand it. Listen, there's ways to do things in these markets. Make sure you're getting your backsides protected. The allocation is everything. We've had Joey. Joey's going to be on Monday. He can go through it again. Everybody that has made the call and said, hey, help me out, you're saving a ton here because there's places to go in these markets where you just don't lose as much as other places, Jason. And it's sad because here it is. A lot of people, Goldman Sachs, right? Think about our central bank and our Treasury Department is loaded with Goldman Sachs employees. And how bad were they and how big did they miss this that a lot of their customers, Goldman Sachs says it's going back to 40, kept their money in there, and now it's getting run over again.
Yeah, Joe, the situation that's set up right now, and Joe and I, we sell gold. So it's not popular, and it's not to our best interest to say, well, I think gold may go down. But even if it does, and Joe and I have had this discussion, if we are looking at a market downturn where all asset classes are going to get trampled, even gold and silver, what's going to happen is gold and silver will drop the least. If the inflation keeps happening, the bank is going to be worse than gold. The markets are dropping. That's worse than gold. Bitcoin? Are you kidding me? Robert Kiyosaki actually semi-seriously said he sees Bitcoin at 1,100. So if I had $10,000 right now and I had a crystal ball and I saw where everything was going, I'd put it all in gold and hold on and hold on for the next couple of years, Joe, because it's going to get really crazy.
Yeah, and again, for those monies where you're like 401ks, IRAs that you can't do that with, call my son. At least get yourself to where you're gonna lose a lot less. 602-909-9048. We've got new lows now for the year. Just like we said, back when we had that rally over the summer, it really was a rally on a bunch of hopes and prayers. Janet Yellen, how much skill and luck the central bank's going to need. Listen, first of all, they don't have skill. And luck has been the only thing they've been operating on. But here's now, I think, really, look at the UK. This is a prime example of, I've said it how many times. The Fed talks about all these tools. We've got this tool and that tool. And we got this tool belt. We're like Bob the Builder. We got this tool belt that's got unlimited tools in it. It's the same tool. It's a debt tool. That's it. That's all it is. And now in England, when inflation is running rampant and they're trying to cut off the supply of debt, the government comes out and says, oh, my gosh, the people are in trouble. We got to bail them out. Jason, the inflation problem is this thing is roaring now. This isn't a campfire type thing. This thing has gotten out of control, and the forest is on fire here. And I'm going to tell you this. Be thankful, right? Yeah, Europe's got it worse than us, but Jason, it's going to be just as bad here.
Well, look, just in the course of about 1 week, you started talking about how horrible the yen's dropping in Japan, huge emergency, and now we're ending the week with England and Europe having massive problems that seems to even be more insurmountable than what Japan's dealing with. This is going to be the news cycle from now on. As one of the things they try to get people that are in these currency markets to feel good about is they just compare them to each other. Well, when you compare a bunch of losing currencies to each other, you're still losing if you're involved in any of them, Joe.
And this is the thing. I think this thing of, obviously we're the reserve currency, so yes, we are at an advantage over the other currencies, but only until the banks start hemorrhaging. An article broke yesterday, and I'm going to share it with you because it had to do with Credit Suisse. And Credit Suisse is getting ready to wield the axe and a huge round of layoffs, according to the Financial Times, received an email that the bank was actually going to exit the United States. This is a story that broke yesterday and saying that Credit Suisse was getting ready to fire more than 10% of its global workforce, including exiting the U.S. market. Now, Credit Suisse, through Bloomberg, is denying that email, saying that email is categorically false. But again, I bring it up because where there's smoke, Jason, there's fire.
Exactly, Joe. You can only make decisions based off the information that's given, right? Whether it be false, wrong information, or if it's factual, correct information. And then you have to say, well, where's this headed? So, Joe, what you're doing is what anybody with common sense would do is like, well, this is the situation laid out. And this is the way it looks, Joe. And that's what you're doing. It's like, well, right? Everything about the news cycle.
I don't know, but let's go back to the original report. Again, this was coming from the Financial Times, so that's credible. That's a credible source.
Yep.
They said that the bank was going to divide itself into 3 parts. One of them includes a bad bank, where they were going to start putting all of the assets that they think are getting ready to default. So this is eerily similar to what we started hearing during the financial crisis, these talks of bad banks, where Credit Suisse now is at least, obviously they had the conversation. Somewhere within Credit Suisse, a conversation was had of breaking the bank up into a bad bank, a good bank, and an investment bank, and getting ready. It's a sign. Obviously, Credit Suisse is denying it. I don't think, what other choice do they have but to deny this? But the fact of the matter is they've obviously had these discussions. And I said, this is why it doesn't matter who's got the cleanest shirt in the dirty laundry. These banks are the problem. They've always been the problem. All of the derivatives on their balance sheets. We already know all throughout Europe and the UK, they're bailing out their energy companies. They're trying to come up with bailouts so people can keep paying their mortgages or paying their rents. Sooner or later, Jason, this problem is going to start cascading, and you're just going to have, whether it be personal businesses not being able to pay their debts, and it's going to cause a problem.
Yeah, we're only 1 week away from October, I guess, right? And so you have a cartel that runs this planet when it comes to the economy, Joe, the banks, the corporations. And even though they're in lockstep with each other, when the markets get ready to go, they've got to figure out how to empty assets, sell their stuff off, right? So that they're not really screwing their buddies on whatever other bank, whatever other company. They work together. So at some point, a few of them probably get they sweat a little bit. What if the other guy sells his stuff first, right, Joe? This is why we have these big market crashes that come on really hard. Maybe we end up with that situation. Maybe October really is when things really fall apart.
Yeah, this is, and again, it's just a sign here. And Jason's right. Listen, these banks are going to hang together. The last thing they want to do is throw one of them under the bus. Right? Remember Lehman Brothers, right? The Lehman moment as we talked about it. This is the first sign of it. Right now, obviously, all the central banks, oh no, the banking's fine, the loans look fine. They're fine until they're not fine, right, Jason?
That's exactly right, Joe. And I like the Lehman Brothers mention, because it is, when it comes to these moves in the markets that are big, like 2008, there's always a game of musical chairs, and one of the big players always tends to be the sacrificial lamb, so to speak. I remember a movie called Margin Call with Kevin Spacey, and this is about this big firm that's decided, they figured out that there's a problem with their mortgage-backed securities, so they're going to dump it all the next day. The whole movie takes place over one day. And Demi Moore is one of the higher-up characters in the firm, but they need to throw someone to the wolves, so to speak, because they're going to basically they're going to sell all their assets and then fire all their brokers because the company has to downsize. And they just threw their own to it, Joe. Demi Moore's like, the top guy came in, it's like, Jeremy Irons is the actor. He's like, well, I got to throw someone to the wolves. It's going to be you. It was just blunt. It was cold. And she got well compensated for it. So, Joe, which one is it this time? To me, it's one of these big banks, maybe two of them, they're going to get thrown to the wolves. I swear when this thing is over, you're going to see a couple of the big players take the fall.
Yeah, and the question will be, which banks will they be, and what are the ramifications of those? As an example, we talked about Goldman Sachs. Goldman Sachs has a very large portfolio of what I would call risky credit card debt, lower FICO score credit card debt. They are seeing an alarming amount of people now 90 days or more past due. The Consumer Financial Protection Bureau just came out talking about recent automobile purchases. The delinquency rate for the first 2 years after purchase, and they're going only, they're saying 2021 and 2022. Well, the problem with that is that's not even 2 years yet, right? But already they're saying loans auto loans originated in 2021 and 2022, the delinquency rate is 13% higher than loans originated, say, in 2018, 2019. And they're saying that the reason is the monthly payments are 20+% higher. But these are signs again, right, Jason? Signs that things are cracking. Obviously, I think what's happening in Japan, what's happening in Europe, the crack could start there. China, another place, the crack could start there. But these banks are so woven together, as we all learned during the financial crisis. Doesn't matter really where it starts, does it?
No, it doesn't. It's funny because it's the smaller banks that carry a large amount of those car loans, and if the prices of used and new cars start to drop because people can't buy them, then you're going to have a lot of these car loans where people are barely making the payment, and then they're going to find out, well, wait a minute, my car's not even worth as much as I owe on it. And you have the same sort of thing you had with the housing market, Joe, where people just walk away because it's like my car's not even worth as much as I'm paying for it. That number could get huge next year, Joe.
Something else to think about, right? Patriot Radio News Hour. We'll be back after the break. We're back. Patriot Radio News Hour. Joe and Jason here. The Dow down almost 500 points now, 29,006. The S&P's down 65, 3690. The Nasdaq's down 200, 10,870. Gold's down $25 here, 1645. Silver's down 70 cents at 1885. Crude oil, I don't mean to laugh, but crude oil is down $4 again. Everybody's starting to worry that this is going to forget about a soft landing. This landing may be a crash landing as chaos has broken out in the currency markets for the second time this week. The British pound at 1093. So almost down to 108 in change. The euro at 97 cents. The Japanese yen back above 143. And here's the problem. The inflation just doesn't stop. FedEx, remember FedEx, they probably started this whole thing, right? They came out with the big warning. Their CEO said, listen, this is already a global recession. They announced, they are going to be swinging the axe and swinging it hard. They plan on saving between $2.2 and $2.7 billion during their current 2023 fiscal year cost reductions. As we mentioned before, FedEx is laying people off. They're closing facilities. We already knew that. We just didn't know how big. Now we do. On top of that, and this is the part that gets scary, it announced its largest rate increase in company history. Jason, 6.9 to 7.9, so 7 to 8% increase across the board on all types of deliveries from FedEx. This is the largest increase in their history, and this is the problem, right? Hey, we're slashing yet raising prices.
Right. Well, there's going to be a lot of big businesses doing the same thing. You just announced yesterday that Walmart, for their holiday season, is only going to hire 40,000 new people. You know, and I had mentioned that they're building warehouses in the back of some of their stores, so that some of that could just be to take stock of all their new supply that's not being bought up. So everything you've mentioned, Joe, from day to day to day, with what is getting ready to happen, and what we say getting ready, it's been happening, hasn't it? This has been going on since 2021, basically, since coronavirus, essentially. This is just a long-term, really bad economic mess. It's, you know, when the history books look back at it, Joe, it started in 2020, and it goes to what X year, 2030, 2028. Yeah. It's going to go on for a while.
Yeah, and really for me, it probably started more towards the financial crisis, 07, 08. They didn't fix it. They papered over. But you're right, 2020 with coronavirus, the central bank of the world, they went on to complete idiocracy. That's the only words I have to describe how much money they created and the scope of it. And this is why we've been saying rates are going to be so much higher than people think, because people don't really understand how much money they actually created. And I remember, I think it was yesterday, I said, go back to the 87 crash, go back to the dot-com bubble crash, go back to the financial crisis crash, go back, add up all of that money. Matter of fact, add up all the money from 87 to up through 2020. Crashes, non-crashes, and they produced more money in 2020 than all of those years combined, Jason, and it's just havoc is here.
You know, something we don't cover as much when it comes to looking at the history that we can compare what's going on to, and it's a little different situation, but in 1920, this is just 7 years after the Fed got its power. In 1920, they had a huge market crash. There was market craziness going on in 1920, which they papered over just like they're doing now. And then you didn't have the huge market crash start till 1929. Look at that 9-year period, Joe. Whereas you had the economic crisis, the 08, 9, 10, right? And now you have what's going on now about, 10 years later. It's kind of the same situation. The only thing is we didn't really have a roaring 20s in between. There wasn't, with all the debt that we have, there wasn't a lot of room for a roaring Obama administration, essentially.
Yeah, and again, we had roar. Well, think about this though. Did we though? We saw the stock market was essentially 15,000 before it crashed. Well, it got to 37. Right,
yeah.
So think about.
I guess that's roaring. Yeah,
going right. I mean, it went all the way down from 6,700 to 37,000.
That's kind of like the Roaring 20s. That's kind of like the Roaring 20s.
Housing prices, $130,000 home went to $500,000. Right, so there was these huge bubbles that got created, and like I said. When the financial crisis happened, they reinflated it, and now they put so much in it that the explosion this time around, it is going to be significant. I don't see the way out, and now we're starting to see, like I said, we're not talking about this happens in emerging markets. What happened in Japan earlier this week, what's happened in the UK today, these are emerging market problems, not G7 countries.
Well, Joe, and if what you're saying, it does compare nicely with the 1920s. And what happened? You ended up with a depression and a world war. That's how that one ended. That's how that reset happened. I don't know what the reset's going to be this time, Joe, but it's always going to be something dramatic.
Let's hope it's not that. But yeah, I just see this as, the 30s depression was a deflationary event. We're in this inflationary event. But again, all the smart guys are all telling you, because they're already over it, right? They already inflation's it's here and it's roaring and it's a forest fire. But these banks and these rate hikes. Wait till the deflation gets here. That's why you're hearing guys like Gunlatch and Dalio and all of these other guys saying, wait till you see what happens by getting rid of all of this money and the size and the scope of it. It's going to be really devastating.
Yeah, and like we've been saying, Joe, is it going to be just a gradual grinding crash, or are we going to have a huge drop-off? So I guess we'll be watching October closely, because that's one time frame we've been thinking could be a huge downward turn in everything, Joe.
Yeah, and it's right around the corner here. Jason and I will be right back. 800-951-0592, $20 gold. We were at 2030. We're going to go back to 1995. So another opportunity here to buy $20 gold below 2,000 just during the commercial break. What was that, a couple minutes? The Dow has lost another 100-plus points now, almost down 600 points. 29.4 in change. Jason, as the sell-off intensifying, the UK 10-year note rose 26 basis points. Jason, that is absolute insanity. I mean, a bad day would be like 10 basis points, 15 basis points. That's double that number.
Yeah, Joe, it definitely has the feel that, the not hugest players in the markets are deciding, the big players, not the huge players. It has the feel that they're starting to empty out, Joe. So that's what it feels like. It feels like the big guys are getting out. The huge players are going to try to hold it up for a while, but this thing looks – we've been watching it for a while, Joe. We've been prognosticating it's going to happen. It sure seems like it kind of in slow motion. It's just happening, and now it's moving a little faster today. It looks like the 1,300-point drop we had last week. That's kind of what it looks like we're heading for today.
Boy, I hope knock on wood there. That was a 5% drop. Right now, the Dow is down 2%. At 580 points to the downside. Let's hope it doesn't get much worse than that. On a positive side, the Chinese are back into the gold markets. The number one gold consumer in the world totaled 166 tons in August. That's up 3% month to month. It's up 11% year over year. They say the number was very impressive, given the COVID resurgence and subsequent restrictions. But it looks like, Jason, the Chinese are back in these gold markets again.
Yeah, I don't know if they've ever exited, Joe. Maybe they slowed down on the purchasing, but they're selling. They've sold over $100 billion in the U.S. Treasuries. They're going to put that money somewhere, aren't they, Joe? It looks like gold.
Yeah, and it's just tough. It's tough watching this. I'm thinking about FedEx. Here's one of the things, too, that we haven't talked about, share buybacks, which has been a very big part of this market. Obviously, when you have companies like FedEx swinging the axe here, that usually means, hey, maybe they're still going to buy back some stock, but they're not going to be buying it at the levels that they were accustomed to them seeing. I think a lot of companies over the next, say, 90 to 120 days, Jason, are going to be cutting their buybacks here. I think that's going to kind of further pressure the equity markets here, because that's a big part of the business.
Well, so buybacks being cut back, depending on which company it is, those were some of the biggest players that keep this thing floating, Joe. So if you have some of the bigger companies, let's just say Walmart or companies of that size, stop doing buybacks, this market will crash very quickly. That's a huge part of keeping it up, Joe.
Yeah, the U.S. Department of Agriculture saying that poor harvest this year expected in the United States, stressing that the current market expectation on global grains and oil seeds, they're now saying that they're going to need 2 consecutive normal crop years to stabilize the markets. Because this year's crop is going to be well below average, 8% lower than the total amount last year, Jason. And that's U.S. numbers.
Yeah, 2022 is going to go down as quite the year, Joe. In 2020, we had coronavirus, and the whole world had this massive emergency. I mean, it was in everybody's thoughts 24 hours a day. But quite frankly, the stuff that's going down in 2022 is much more severe. It's just coronavirus kind of sort of magically went away this year. I think the average person out there is thinking everything's better, but economically, this is far worse than 2020, Joe. This is abysmal what's going on.
Yeah, and here's the hard part, right? Higher rates. That's not good for farmers.
Nope.
That's not good for farmers. We already know fertilizer, right? Energy is like the primary thing in making fertilizer. It's one of the primary costs. Fertilizer prices, everybody knows, went sky high. If we start losing some of this housing wealth and start losing some land wealth, obviously the water problems, we haven't even talked about that, right? The issues with water in the Colorado River and the effect on harvest going forward into the future. Food inflation is one of these things that I think a lot of people thought the worst is over and that we'd be hitting a plateau, and now all of a sudden everyone's kind of saying, I think they may be going higher. We're not there yet, right? We got higher prices to go before we get there.
I agree with that, Joe. I do agree with that. But if all these markets get crushed really significantly in the coming weeks and months, quite frankly, the way the inflation goes down is because people can't buy anything, Joe. I mean, the prices will drop if nobody can buy anything, and I think that's the Fed trying to attack inflation. They may be starting to get what they want, Joe. Maybe they get the inflation under control a little sooner, because I know they prognosticate by next year, but getting it down to 2.5% next year, Joe, if that's the destruction of all markets and all abilities for people to make money and buy essentials, that's not really a cure to the problem, is it?
U.S. $20 Liberties, 1995 at 800-951-0592. Jason and I are coming right back. Final segment of the week. 800-951-0592. I got some good news. The Dow hasn't gotten worse. So we survived a commercial break here, still down about 580 points. The S&P's down 77. The Nasdaq's down 220. Gold's now down 24. Crude oil down almost $5. The latest on inflation. So Jason, he's been saying, hey, let's not forget the inflation from 2021. Right? Let's not forget that. Well, apparently the latest data out, Americans would need to be making $11,500 more a year to have the same standard of living that they had in 2020. That doesn't count the rate hike we just got, right? So that's going to make it worse. But here's what they said. In 2020, the average American household spent $61,300. That would now cost them $72,900 just to stay where they were. And in certain states, Colorado being one of them, Arizona being another, Utah being another. But it's kind of funny. Those are three states that we're in. In those states, just in 1 year, you're looking at 11, right around the 2-year average for all states, 11.5. Colorado's at 11.2. Utah's at 11. Arizona was at 10,800 for just 1 year, Jason.
That's right. And really the comparison should be to 2019, because 2020 was just not a year that you can quantify in any kind of regular terms, because not only did everything get shut down and stop for a time early in the year, but then they started giving out all kinds of free money. So even in 2021, they gave out some free money early in the year. So it's hard to compare to 2020 when really 2019 is what we got to be looking at. What were you spending to take care of all of your expenses in 2019? That's really where it's at, Joe, because 2020 was a weird year, and then the inflation started in 2021. And you have to earn a lot more money. I keep telling people when they new people to gold that if you had $100,000 in the bank at the end of 2020, and you still have that $100,000 in the bank today, you're looking at your account and say, yeah, there's $100,000 still there, but you're probably only going to be able to buy $70,000 worth of stuff that you could have bought in 2019 or 2020, Joe. That's how much the inflation is probably eaten away just in a 2-year span, Joe. It's incredible.
Yeah, it's scary, because when you think about, let's face it, what is it? 54% of Americans make less than $50,000, right? And they're talking about you need to be able to spend $73,000. It really is a tough thing. $20 gold, like I said, 1995 at 800. 9510592. We've got new lows for the year playing out on Wall Street here. We'll see how it gets. The big news of today happened in the UK, where the UK government essentially just cried uncle and handed out billions and billions and billions of dollars in giveaways while the central bank was trying to fight inflation, and it's causing a currency crisis. I guess the good news is going to the UK is going to be a lot cheaper for Americans, at least for now. Patriot Radio News Hour. God bless everybody.